transparency. Welcome to the Money System, where we explain how money really works.
Have you ever bought a stock thinking it was cheap, only to watch it fall even further? Or maybe you avoided a stock because it looked expensive, just to see it skyrocket without you. It's a frustrating feeling, right? You're not alone. Many investors struggle with this exact problem. They look at a stock price, say $100, and think it's expensive, while a $5 stock seems like a bargain. But what if I told you that a $100 stock could be incredibly cheap, and that $5 stock could be a massive trap? The secret isn't the price tag. It's understanding something called multiples. And by the end of this video, you'll have the tools to tell the difference like a pro. So what exactly are these magical things called multiples? Think of them like a price per pound sticker at the grocery store. You wouldn't just look at the total price of 2 watermelons to decide which is a better deal. You'd check the price per pound to see which one gives you more value for your money. Stock multiples do the same thing for companies. They are financial ratios that help us compare a company's stock price to a key business metric, like its earnings, sales, or book value. This helps us standardize the comparison, cutting through the noise of different share prices and company sizes. It's all about getting a sense of how much you're repaying for a slice of the company's business performance. Is the market currently charging a premium for this company's earnings, or is it on sale? That's the question multiples help us answer. Let's dive into the most famous multiple of them all, the price-to-earnings ratio, or PE ratio. You've probably seen this one thrown around a lot. The formula is simple. You take the current stock price and divide it by the company's earnings per share, or EPS. For example, if a stock is trading at $50 per share and its earnings per share over the last year were $2, the PE ratio would be 25. This means you're repaying $25 for every $1 of the company's annual profit. A lower PE ratio, say 10, might suggest the stock is cheaper, while a higher PE, like 50, could mean it's more expensive. And this is a huge but, context is everything. A PE of 25 isn't inherently good or bad on its own. It's a starting point, not a final answer. This can be more useful because investing is all about the future, not the past. If a company is expected to grow its earnings significantly next year, its forward PE will be lower than its trailing PE, making it look more attractive. However, there's a catch. These are just estimates. Analysts can be wrong. The company could face unexpected challenges. So, while forward PE is a great tool, you have to take it with a grain of salt and understand that it's based on predictions, not certainties. A company with a very low forward PE might look like a steal, but you need to ask why. Are those future earnings realistic, or is the market skeptical for a good reason? But what if a company isn't profitable yet? This is common for new high-growth companies that are reinvesting everything back into the business. Their earnings might be zero or even negative, which makes the PE ratio completely useless. In this case, we turn to another powerful multiple, the price-to-sales ratio, or PS ratio. This is calculated by dividing the company's market capitalization, which is just the stock price times the number of shares by its total revenue over the last year, or more simply, the price per share divided by the sales per share. The PS ratio tells us how much we are paying for every dollar of the company's sales. It's a great way to value companies before they hit profitability. Just like with the PE ratio, a lower PS ratio is generally seen as better. You'll want to compare it to the company's own history and its industry peers to get the full picture. For a software as a service company, a PS of 8 might be normal, while for a grocery store chain, a PS of 0.5 might be typical. Again, industry context is king. Next up, let's talk about the price-to-book ratio, or PB ratio. This one compares the company's stock price to its book value per share. What's book value? In simple terms, it's a company's total assets minus its total liabilities. It's a rough estimate of what would be left over for shareholders if the company were to liquidate everything today. A PB ratio below 1 means you theoretically buying the company's assets for less than their stated value on the books, which can be a classic sign of an undervalued stock. This metric is particularly useful for industries with a lot of physical assets, like banks, insurance companies, and industrial manufacturers. However, it's less useful for tech or service companies whose main assets are intangible, like brand recognition, intellectual property, or software code, which aren't fully captured on the balance sheet. So, a company like a software giant might have a very high PB ratio, but that doesn't necessarily mean it's overvalued. So, we've covered PEPS and PB. Are we done? Not quite. There's another layer we need to consider: growth. A company that's earnings by 30% per year deserves to have a higher PE ratio than a company growing at just 5%. This is where the price-earnings-to-growth ratio, or PEG ratio, comes in. It was popularized by the legendary investor Peter Lynch, and it's a brilliant way to add context to the PE ratio. You calculate it by taking the PE ratio and dividing it by the company's annual earnings growth rate. A PEG ratio of 1 is often considered a good benchmark. It suggests the PE ratio is fairly valued in line with its growth. A PEG ratio significantly below 1 could signal a wonderful bargainer stock that is cheap relative to its growth prospects. A PEG ratio well above 1, say 2 or 3, might indicate the stock is overvalued and you're paying too much for its future growth. The PEG ratio helps you avoid the classic value trap of a low PE stock with no growth, and the growth trap of a high PE stock whose growth can't justify the price. Remember, no single multiple tells the whole story. A professional investor is like a doctor running a full diagnostic panel, not just taking a patient's temperature. You need to look at a combination of these multiples. Is the stock cheap on a PE basis? How does it look on a PS basis? What does the PEG ratio tell you about its valuation relative to growth? If a stock looks cheap across multiple metrics compared to its history and its peers, you might be onto something. But if it only looks cheap on one metric and expensive on others, you need to dig deeper and ask why. Maybe there's a good reason. Perhaps the company has a lot of debt, which isn't reflected in the PE or PS ratios, but makes the business riskier. This is why multiples are the start of your research, not the end. They point you in the right direction. And then it's your job to investigate the company's health, its competitive advantages, and its management quality. So let's recap the key takeaways. First, a stock's price alone tells you nothing about its value. A $5 stock can be expensive and a $500 stock can be cheap. Second, use valuation multiples like PE, PS, and PB to get a standardized measure of a stock's price relative to its business fundamentals. Third, context is everything. Always compare a multiple to the company's own history and, most importantly, to its industry peers. Fourth, for growing companies, use the PEG ratio to see if the price is justified by its earnings growth. And finally, use a combination of these tools. Don't rely on just one. By mastering these multiples, you can stop guessing and start making informed decisions. You can finally gain the confidence to identify truly undervalued gems and avoid those overhyped stocks that are destined to fall. This might seem like a lot to take in at once, but it's a skill that builds with practice. Start by looking up the multiples for stocks you already own or are interested in. Go to a financial website, type in the ticker symbol, and find the statistics page. You'll see the PE, PS, and PEG ratios laid out for you. Compare them, see how they stack up against their competitors. The more you do it, the more intuitive it will become. You'll start to develop a feel for what looks cheap or expensive within different sectors, turning you from a passive observer into a savvy, value-conscious investor. Thank you so much for watching. I hope this guide helps you feel more confident in analyzing stocks. If you found this video helpful, please give it a thumbs up. And do forget to subscribe and hit that notification bell so you won't miss our next deep dive into the world of investing. Do you have a favorite multiple you like to use? Let me know in the comments below. See you in the next video.
So, we're not smart. If this helped you understand the system, subscribe, like, and share this video.